What is up, everyone, and welcome to DeFi Digs. It's been quite a while since I've uploaded a new video. I, like many of you, have been nursing my bear market wounds, but I'm still here. We're still learning, and I'm going to try to establish a regular upload cadence in the coming weeks. But today, we're going to look at Vesta Finance, a collateralized debt protocol that's on Arbitrum. It lets you borrow Vesta's stablecoin VST against a number of different assets. We're going to deep dive into all aspects of the platform, looking at all the vaults that are available, which are the assets that you can borrow against, how the stability pools work, what the liquidity mining options are, and then also a recent update that introduced the Vesta reference rate. I'm going to spend a good chunk of the video on the GLP vault, which utilizes the GLP token from GMX. And has been one of the more interesting DeFi strats to emerge in the last few months, in my opinion. And then finally, we'll take a really quick look at the VSTA tokenomics towards the end. Before we get started, I have to say nothing in this video is financial advice. This video is for educational purposes only. Crypto is risky. Always do your own research when you're considering investing or using any protocol. Let's dig into it. Okay, so starting on the left up here, we're going to do the product section first, and this is the vaults that you can open up a position on. There are currently 5 vaults. There were 6. The 6th one was paused, and that was REN BTC. As I understand it, Alameda was pretty heavily involved in the REN project, and so the core dev team is trying to figure out kind of the best way to distance themselves and kind of safely move that protocol forward. So REN BTC Vault no longer an option currently, but we do have ETH, OHM, GMX, DPX, and GLP. Each vault has its own minimum collateral ratio, which is this MCR figure right here. They all range around 110% upwards to 150, so that's pretty low for something like ETH. They also have a mint cap that is the maximum VSD that can be minted within that vault. They're all pretty far away from that cap, so that's not really an issue. The GLP vault was at the cap, but they just increased it to 7 million from 5 million, and there's also been some people pulling out, I think because of the Vesta reference rate, which we're going to dig into a little bit later. To open up a vault, it's pretty straightforward. Just click on which asset you like, hit open vault, however much you want to deposit, and then decide however much you want to borrow against that. So whenever you choose the amount, it's going to tell you the actual debt ratio that you have, what price you'll get liquidated at for that asset, the current Vesta reference rate, which will vary based on how close to peg the VST stablecoin is. So right now this vault's at 2.64%. And then your estimated total annual interest based on that interest rate. On the right hand side, similar numbers, similar figures that what we saw on the last screen. Each vault also has a stability pool, and I'm going to cover that next, but this will tell you what the APR is as well as what the liquidation bonus is for that specific asset. So $21.5 million total collateral deposited, about $9.5 million borrowed. Portfolio section, pretty straightforward. I do have a GLP vault opened up here that I've been kind of tinkering with. And then in the staking section, we have the liquidity mining options, which are pretty standard. There's the VSTA, which is their governance token, and the ETH pool. That is paying out currently around 36% in VSTA tokens. And then there's also the VST Frax pool, which is paid out in VSTA as well as FXS here. I think this pool is deprecated, this VST4 pool, so I wouldn't worry about that. And then the stability pools. So some of you may be familiar with this if you've used something like Liquity in the past. There's a number of protocols that have something very similar, but what it is essentially a way to automatically benefit from liquidations by depositing the VST stablecoin. So let's say you wanted to earn some ETH. Actually, let's use GMX as an example, because this one actually has an APR here, some yield. Some of them do, some of them do not. So Ohm has a very small VSTA APR. DPX is paying out in DPX, and GMX similarly also paying out in GMX. The process is basically deposit VST. It has to be VST, so the stablecoin from Vesta. And then when people get liquidated, you will receive some amount of the asset of the stability pool you're in. So if I'm in the GMX stability pool, GMX dumps quite a bit, a bunch of people get liquidated, I'm going to be receiving some GMX, essentially buying it from my deposited VST. And as a bonus, I'm going to be receiving this liquidation bonus for kind of participating in the liquidation. So I'll be getting a 15% bonus on GMX compared to if I were to just market by that somewhere else. So sort of a way to kind of like dynamically DCA, I suppose you could say, into a specific asset. You're going to get probably a good price because they're only going to get liquidated on a dump or a dip. And then you're also going to get that bonus on top of that. And then you're also going to be getting the yield on top of that. So if you're looking to accumulate some of these assets here and you're kind of trying to, you don't really want to worry about timing the market, but you want to make sure you get a decent price, this is kind of a good way to do that. There are different liquidation bonus amounts for each assets. ETH is 10%, GMX, DPX, those are 15%, so a little bit more from those. Kind of a cool mechanism. I don't have any VST deposited currently, but that is how you do that. And then the last three, we're not going to cover too much. They're pretty straightforward. One is just the stats that'll break down various stats from the protocol. The claim tab is where you go to claim your VSTA, and the collectibles was like an NFT pass that they were giving out a while back. So I don't think you'll have much use on that. Let's chat about the GLP vault. That's what I want to spend a good chunk of time on. I think it's super interesting. So as I mentioned earlier, or maybe I did mention earlier, but some of these vaults have a yield on them. These other vaults, DPX, ETH, and Ohm, there's no yield. These aren't yield generating assets, so you just deposit it and can borrow against. But on these other vaults, GMX and GLP, both obviously being built on GMX, both of those assets, if you were to use GMX, you can deposit them to get a portion of the fees that are generated and trader losses. So on GMX, you can stake the actual GMX token and be receiving this yield here, and then on with GLP you can do the same thing, although you don't need to stake it, you just hold it in your wallet and you'll be earning this yield here. So what Vesta's done is basically if you open up a vault with one of those assets, they're going to deposit those assets into GMX and then pass that yield back to you. So you can actually borrow against a yield generating asset while it continues to earn yield. And then if you want, kind of lever yourself up on that yield. So that's what I've been doing with the GLP vault. A couple notes: they used to have I think a deposit and a withdraw fee, but those have been removed in place of the Vesta reference rate, and they do have a 20% performance fee on the yield that you're generating. That is a little bit higher than usual. I think I typically see 10, maybe 15%. So that's something to keep in mind. If you're wanting to make the same amount that you would on here, then you're going to need to be 1.25x leveraged on your position, and that will cover the 20% performance fee. So keep that in mind. The reference rate is something they recently introduced in place of the deposit fees, and that is a interest rate that you'll pay that varies based on how close to peg the VST stablecoin is. So the lower it is, The further off from peg it is, the higher the reference rate's going to be. Their thinking is that if the reference rate is high and the value of VST is off peg on the low side, people are going to be more inclined to buy back, add buying pressure to VST, repay their loans, and kind of close them out so they're not exposed to that reference rate. It seems to be working somewhat. The VST peg right now is a little over 1 cent off. It was sitting at around like 97 cents pretty frequently before the reference rate. I'm not a huge fan of it just because they used to not have any interest rate on the vaults, which is what the same model that Liquity has. And that's obviously really appealing. You can leave your assets in there as long as you want and not have to worry about that. I also don't love that they're thinking of peg stability is to get people to close their vaults out and basically use the platform less. So not a huge fan of the reference rate at this point. I know that they're not either. They've communicated that it's sort of the first iteration and they're working on it. So I am expecting kind of some changes to this. But even with that, with the GLP vault specifically, it's still a really interesting strategy, and let's kind of break down why. So for those of you that don't know, the GLP token is the liquidity provider token for GMX. It basically houses all of the assets that the protocol uses to trade on, and it's made up of, you know, a bunch of different cryptocurrencies, but the composition of it you can see right here on the GMX site, app.gmx.io/dashboard. And currently it's about 30% Ethereum, 20% Bitcoin, a tiny bit of Chainlink and Uniswap, and then about 50%, 45 to 50% stablecoins, various stablecoins. So that sort of puts it at a 50-50 crypto to stablecoin ratio, which means that it has dampened volatility as the stablecoins obviously just stay pegged at $1, and the only volatile assets are the other 50% of the GLP, which is Ethereum, Bitcoin, and then a little bit of Link and Uniswap. So when you get violent swings in price, leverage is very risky because your 150% collateralized ratio vault in ETH can go down very, very quickly. But that is dampened because of the stablecoin balance in GLP. So it's not quite as risky to open up a leveraged vault in GLP. The downside movements aren't going to have, it's going to take a lot more to move this collateral ratio versus just an ETH or a Bitcoin vault. So that's one reason. Of course, that's also going to play a part on the upside. So you're not going to be generating as much as big of gains as you would if you were to just hold ETH or just hold Bitcoin, because you are in 50% stablecoins. And then the other component of it is of course, the yield. So this varies quite a bit based on trader activity, but as long as you're leveraged up, like I said, 1.25x plus a little bit more to cover this Vesta reference rate, this is only being charged on the actual debt that I have. So this 4% is on this 1281 VST, not the total position, just on the borrowed VST. So my total position is about 2,700. So let's call it about 2 to 3% that we need to cover off of this yield from this Vesta reference rate. So about 1.3x. That's just some rough napkin math, but right in that range. If you're leveraged up on GLP about 1.3x, then you're going to be covered on all of the fees, the reference rate, the performance fee as well. Of course, this can jump quite a bit if this goes down a lot. So that's just sort of a general rule of thumb rather than something hard to follow. But 1.3x, if we do about 1.7x, which I think is the leverage that this vault is roughly. Just taking this current ETH APR, which is obviously very variable, and we multiply that times 1.7, that's 43%. So on my original position, which was about half this, I'm making a 43.67% yield on ETH, which is pretty cool, and that's with dampened, or should I say minimized, kind of exposure to the downside, dampened volatility because of the GLP composition. And I'm also leveraged up on some very strong assets in ETH and Bitcoin. So if I were to just hold this for a long time, I'm still going to benefit from those price appreciations. Not as much as I would if I were to just hold ETH or Bitcoin, but I still will benefit some. And in the meantime, I'll be generating this 43% yield or however much it is based on trader activity. So super cool strategy. I don't love the reference rate, but other than that, this has been one of my favorite bear market strategies, just because I can stack ETH and do it while holding ETH and Bitcoin and stable coins. And then I can kind of borrow and deleverage or leverage up even more as I see fit. Super easy to adjust your position, add more, take some away, repay. You do have to keep a minimum of 300 VST open, so that's one thing to consider. But yeah, I would check it out, guys, if you haven't taken a look at it. It is super interesting. This was locked at 5 million out of 5 million VST. There's plenty of cap space left now. And you also have GMX, which is similar, but of course, it's just a GMX token as opposed to the GLP token. So a little bit riskier there, in my opinion, and a little bit less of the APR. But if you're just sitting on some GMX, it's another decent option to consider over the just regular staking. A couple things digging into the docs here. If you want a quick snapshot of how the protocol kind of has parameters set for each of these assets, the protocol parameters section will give you a little table that shows the collateral ratio, the asset grade. I'm not sure exactly what goes into asset grade, the performance fee, 20% as I mentioned on GLP. They just removed it on GMX, so there's actually no performance fee on GMX. Whatever the liquidation bonus, and then the current debt ceiling, the current amount, that maximum amount that VST can be borrowed within those vaults. Really quickly covering the VSTA tokenomics, which is their governance token. They have a good breakdown of the distribution. They have a little chart here. So 21% going to the core team, with another 10% going to partners and advisors. They did a little swap, I believe, with Olympus, so there's 1% for them. As far as utility, unfortunately, there's really nothing at this point. It's just a governance token. There's no staking, there's no fee sharing yet. They have talked quite a bit about that over the last few months. I know they are working on a staking module. I think they're redoing it, but they do have plans to implement some form of fee sharing, revenue sharing with the VSTA token via staking. So don't know when that's coming. Probably, I would say, first half of this year. So in the next 6 months, that wouldn't surprise me at all. That's probably the timeline that they're throwing out there. But at this point, just a governance token. So definitely consider that. It is quite a low market cap at this point. Fully diluted of 29 mil, current market cap of 2.6. So pretty low. Probably some good upside here, but again, not a lot of utility. So kind of consider all that before making any kind of investment decisions. That wraps us up for Vesta Finance. If you guys found the video at all helpful, please give the video a thumbs up. Consider subscribing. If you're interested in Vesta, and want to know a little bit more, their Discord's pretty active. Of course, they have a Twitter that you guys can follow as well. But if I missed anything, let me know in the comments. If you have any questions, send me up in the comments or hit me on Twitter at DeFi Digs. Otherwise, I'll catch you guys in the next one. Thanks for watching.